Good afternoon. My name is Beth McArdle. I'm a real estate partner at Shoosmiths. I head up the corporate occupier team in Birmingham, and I have the distinct pleasure of being your host this afternoon, which basically means I don't need to answer any of the difficult questions. So first off, I just want to say I've been in retail for 20 years. I am horribly passionate about it. I love a lease, and I'm just devastated about the lockdown and the implication for this on all of you, our colleagues. So thoughts are with you, and hopefully we can help a little and answer some questions this afternoon. So just a couple of admin points. Number one, we're going to have a couple of polls running. We'd be really, really grateful if you could vote in these polls because it'll be useful intel, which we will, of course, share with you. And we will take questions and answers, but as there's quite a lot to get through and I've got a talkative panel, if you could possibly keep those for the end, I'd be very grateful. But I promise we will get through as many as we can. And any of those that we don't get to, we will answer after the WebEx and then feed back to you. So I'm delighted in the first instance to introduce you to David Broadbent. He's the president of the PMA and senior assets and estates manager at Costa Coffee. So David, welcome and thank you for your time.
Thank you very much, Beth. Welcome and good afternoon to everybody who is currently on the call. I think I can see 44 people. So look, good afternoon from me. What should have been our deferred annual PMA conference up in Manchester. And I think it's fair to say I think we're all probably disappointed not to be meeting in person and also to be enjoying a few drinks this evening at the Ministry of Science. I think I'd echo Beth's view that actually it's been an interesting eight months or so working in property and especially the retail sector with what's been going on. And obviously lockdown level 2, shall we say, on Saturday just didn't really help matters. And the first 2 days of my week have been somewhat not what I was expecting. Just from a lobbying point of view from the PMA, yesterday I had meetings with Ministers Paul Scully and Minister Kelly Tolhurst to discuss commercial rent payments and the ever-increasing debt mountain that this is creating. And interestingly, circa 1.5 billion per quarter is becoming due. This was an hour's roundtable discussion, which included representatives from the tenant focus groups, including the BRC, UK Hospitality, and retailers from JD Sports and Prezzo. Landlord representatives included BPF, Revo, Landsec, L&G, Hammerson, British Land and Alandi. I think my overall summary of the hour's call would be that government is not keen to offer more fiscal measures, and given the lack of parliamentary time, it is unlikely that they will be introducing new legislation. Further roundtable discussions are planned on this topic, of which I will be, shall we say, representing members' views. Business rates. John Sigler has led the campaign from the PMA and has attended all of the BRC roundtable calls on the business rates review and has kindly prepared submissions for both the Tranche 1 and Tranche 2 calls for evidence for the PMA. Yesterday, I wrote to the Chancellor and other MPs pressing for urgent clarity and clarification from what the business rates will be levied from April 2021. And we were able to get 54 named retailers who co-signed that letter. So a big thank you to both Kerry and John for coordinating that piece of work. And thank you to those retailers who were happy to put their name to the bottom of that letter. Emma Simpson from the BBC is now interested in talking further to us on that. And John is leading that conversation. And hopefully that will gain traction. And I would also say that I note in the press this morning that the London Mayor, Sadiq Khan, has made very similar representations yesterday. Moving on to Christmas, clearly Christmas 2020 is somewhat being cancelled, postponed, and unfortunately we are deferring the Christmas conference, Christmas dinner, which did include a new venue and format was planned. What I would say, save the date for Wednesday the 8th of December 2021, all being well. This year we are going to do something. There's a big Christmas quiz planned for Wednesday the 9th, 3 till 5 p.m. afternoon, £12.50 a head, £50 for a team, with a view to raising as much money as we can for Mind, the mental health charity. I would encourage any members on this call who are able to give donations or prizes, e.g. in the way of gift cards, which can easily be posted out, that would greatly support anything to do with the Christmas event. Look, finally, I'll shut up now. I'll hand back to Beth, but on behalf of the PMA, to Shoosmiths and to Johnson Fellows, thank you for hosting today and for putting this event together. Beth.
Thank you, David. And just on behalf of everybody, thank you for all your hard work and continued support with the PMA and to the rest of the committee. It's very much appreciated. Right, now handing over to Ruth Clare, who is a real estate partner in our Manchester office and works in the corporate occupier group with myself. Ruth is going to talk to you about turnover rent, that thing that's become, you know, the regular in our lives these days, and pandemic clauses. So Ruth, handing over to you. Thank you. Or Ruth, you're on mute.
Do you know what? I thought someone had to do it. It might as well be me. As you can see, we're very sorry. I'm Manchester based, and I would echo David's words in that we're very sorry not to be seeing you all in person, not at least because it's actually sunny in Manchester today. I'm sitting in natural light as opposed to the biblical rain that welcomed you all to Manchester last year. So please believe me, I'm telling the truth. It is sunny in Manchester today. So I'm going to be speaking to you about various items. Just to set a little bit of context, the market is somewhat strange. The market was in flux in any event before pandemic, and with the changes to the market, we were increasingly seeing shorter terms, shorter term leases, and also probably an increase in turnover rents. So turnover rents were something that we were dealing with this time last year. Pandemic drafting, I don't think any of us saw coming. So I wanted to separate those out as two very important points and very prevalent in the market at the moment. What I would say is that we are doing a lot of deals at the moment, but we're not doing the deals we used to do. And there's a number of reasons for that. Certainly, there's more lease events happening. There's more breaks. There's more expiries, rent reviews. And people are certainly able to leverage off those events. There's uncertainty in terms of your own boards about what they will or will not commit to. We're not talking here necessarily about new store acquisitions with a huge amount of capital expenditure, and so a 5 or 10 year lease is required to amortize those costs. What we're talking here is existing locations where nobody quite knows if they will continue to be profitable due to the fact that click and collect, which has clearly been expedited by the current crisis, what effect that will have on shopping trends. And all of that makes a shorter lease, even without the protection of the 54 Act, acceptable in a way that it wouldn't have been. Similarly, landlords are keen to keep tenants in their space in a way that they haven't been for many years. And so in the mix of all this mess and the terrible effect of COVID-19 on your businesses, or the majority of your businesses, there are opportunities to deliver cash back into your business in certain instances, to take unprofitable operations and make them profitable. And it's how you future-proof those. So turning first of all to turnover rents, I just briefly want to say, turnover rents, and with my tongue firmly in my cheek here, it's what do you mean nowadays? The turnover rents, we've just launched the first poll. I'd be really interested if you would click on that, and we'll have a look at some results, which would be great because it's all anonymised, so we can see what we're all up to. But turnover rents used to mean a minimum guaranteed rent with a turnover top-up, and it doesn't quite mean that anymore. We are certainly seeing a lot of what are genuine turnover rent deals, so pure turnover rent deals, where they can be inclusive of service charge, insurance rent, even business rates. So there is a lot of, there's a need up front to understand what is being offered. Is it the old school minimum guaranteed rent with a turnover top up? Is it a pure turnover with turnover rent being paid in arrears? Are you going to adopt an on-account rent structure? And if you are going to offer on-account, how is that going to be benchmarked? Interestingly, the on-account structure works very well and enables both landlords and tenants to control cash flow, but only where it actually tracks the rent and tracks the rent for that year. There has been historically, on accounts have been either by reference to a fixed amount or even previous year's turnover. Well, if this year taught us anything, the turnover rent payable in this year will not bear any resemblance probably to base rent or to last year's turnover. So to the extent that you can, we would advocate that your on accounts track your actual turnover in the year. And in relation to that, I would also flag the need to protect your on-account rents, because what we have here is a situation where it's not just tenants who are going insolvent, but landlords. And what you don't want to find is that an insolvent landlord who has your excess amount in their account and you have to try and extract it. You can mitigate that risk by using set-offs or even having a break. So you don't have to continue paying over the odds, but certainly to the extent that you can ensure that your on-account tracks your turnover, we would suggest that you do that. Keep open covenants have also moved forward during this period. The permitted closure events, which always appeared around works, insured damage, alienation, they continue, of course, to be important. But now what we're seeing is, of course, an exception for pandemic closures, as broad as you can get them. And also, landlords are more amenable to including stuff around where you're required to close by law. If this year has taught us anything, is that the unexpected can certainly happen. Definitions of turnover rent continue to be a thorny and time-consuming business to agree. If you can agree a position on click and collect in the heads of terms, that would really help your lawyers before we go into battle. I think most people realise that stocks, where orders are satisfied from stock in store, pretty established now that that forms part of the store's turnover. But what we're seeing is click and collect continuing to be a hot potato. Landlords want to include it, tenants don't. Of course, interestingly this week, if you open for click and collect, that is apparently permitted, notwithstanding the lockdown. So it's going to be very interesting where tenants are only opening for click and collect, but click and collect is excluded from their turnover. We'll see how landlords feel about that. The other thing is in-store ordering. It becomes very difficult now with retail clients increasingly using perhaps a handheld console. The size that you want isn't available in store. That's okay. You can order it from here. Just order the size 10 and it will either be in store or it will be delivered to your home within 2 days. As you try to enhance the client experience and also secure the sale, more landlords are going to become aware of those media, and it's how that is apportioned within your business to the store or indeed to the warehouse where the order is being fulfilled. So that's me on turnover rents, except to have a quick look at the poll. So so percentage of current leases, turnover only. For those that answered, there was about 20, and none for 40% of you, and about so it's about a quarter for the 17% that answered. Thank you for that. And then percentage of rent leases which can include a turnover element is slightly higher. So that's interesting to see anyway. Thank you for those of you that answered the poll. That's really great. So moving on then to pandemic drafting. I wish I could tell you what the market was. So many clients asking, what's the market on turnover, on pandemic drafting? Now, turnover rent leases, as I just mentioned, pandemic is a pretty pushing on an easy door, an open door for turnover rent leases. If your tenant is not open for trade and therefore not, having any turnover, it's difficult to argue that you should be compensated for that. So those pure turnover rent leases, pandemic drafting, our pandemic carve out goes into keep open and we're pretty good condition. Those leases with minimum guaranteed rents or open market rents, it is a complete sliding scale. It depends on whether or not you're leveraging off a lease event. So you're renewing your lease and therefore you're entering into a new arrangement. have you got an existing lease, but you're trying to either record a complete rent-free for lockdown 1? Are you trying to protect your position going forward? So trying to future-proof the leases. Also commercial context, if you're getting a cracking reduced rent or a great rent concession that you can secure immediately for your business, you've got to take that short-term as well as a medium-term view. So we're seeing a massive spectrum of pandemic deals. Lots of suspensions or rent freeze, effectively, for lockdown 1. In terms of future deals, suspensions are less popular, although 50-50 splits are fairly regularly seen. It's a kind of a 50-50 split is an interesting one actually, because it's nobody's fault. So 50-50 kind of sits with people, or there's certain people. The other thing is deferrals. More and more, when we can't get a suspension, the deferral is the plan B. So the whole or part of the rent is suspended for the restriction period, but then repaid afterwards within a specified period of months. So a multitude of deals and a multitude of ways to cut it, depending on the landlord and the overall deal. Landlords are also getting cleverer, and they're trying to mitigate their own risk on this. So 2 things that we're seeing are tenants' insurance provisions. So I can understand that a landlord would not want egg on its face in the event that the tenant was able to claim under its insurance for the rent for a suspension period. That said, very few tenants are able to currently do that, and goodness knows what the market will end up being. So where we have seen this, we've been back and forth with landlords on it. It seems to be coming out that you can refer to tenants' insurance, but there should be no obligation on the tenant to obtain it. Any reference here to reasonable commercial terms or reasonable commercial premiums is really difficult, where there is basically no market for this insurance, or these premiums are so high. What is reasonable? What is commercial? So I think for the time being, we've got to put a pin in it and just say, we have to see what the market. Everyone hopes this will be an insurable risk and that it will be available at reasonable commercial premiums, but we don't know, and it's too difficult to tell. Ability to claim on statutory schemes, David mentioned, I don't think there's going to be much fiscal intervention on principal rents, but landlords still want to cover the position off and make sure that to the extent that a tenant can claim either reimbursement or exemption for its principal rent, it's able to do that, or it's obliged to do that rather than come to the landlord. So seeing drafting around that. In terms of side letter or leases, I mean, obviously a lot of shorter term leases are being done on a personal basis. So there's really no good reason for pandemic conditions to go into a side letter, save for the fact that the landlord doesn't want it in the market. The landlord's primary concern here has got to be confidentiality, and that's why they're all going into side letters. Again, if the landlord will only grant you a rent concession in a side letter, which they're not obliged to do, or it's recording a 3-month rent free, put it in the side letter because it's better than nothing. All I would say is that for longer term commitments, and should you wish to alienate in the future, if you can't offer an assignee or under lessee something on pandemic, then that might make it an onerous lease. I think this is a can we've got to kick down the road. But it is just something to flag. A personal deal may be better than no deal at all, of course, but we don't know what the market is going to end up being in 2 years' time, and the ability to retrofit existing leases with those terms. 2 final things before Beth cuts me off, quite rightly, end of my 15 minutes. The first is service charge. I would hope that most of you have achieved obligations on the landlord to act reasonably in an efficient and economical manner, etc., within your leases. That said, there have been some big bills coming out of landlords for PPE, signage, security, cleaning. particularly, of course, in shopping centres. And it has been to the horror of the tenants on top of everything else that they have these huge service charge bills. All we can say is that, you know, if you can get some sort of commitment from the landlord to have due regard to the circumstances when, during a pandemic, when providing services and incurring costs, that gives you an argument later on. We have had mixed success in achieving that. Final thing is performance of obligations. Winter is coming. Pipes are going to start freezing. And if we can't get into our premises, there's going to be some concerns there. So performance of obligations, to the extent that you can agree that neither the landlord nor the tenant, because it's a mutual concern, is in breach due to inability to perform during a pandemic, then that's going to help. We've also seen this obviously in the context of agreement for lease. You know, you've got vacant possession conditions where the existing tenant cannot get in to strip out, or landlords, tenants' works obligations which they can't fulfil. Particular concern in lockdown 1 when contractors couldn't get into premises. So again, performance of obligations, future-proofing, making sure that if a pandemic event occurs, your rent-free is suspended, as well as all the other obligations, then that's going to help and probably be fair enough. So that's all I have. No definite answers, lots of questions. And then just picking up on the poll, for those of you who answered, thank you very much about what proportion of landlords are sort of giving something. It looks to me like there's a lot of conversations going on, and the majority of those deals that have been done are rent suspensions, which is great. So I think that would probably capture rent freeze as well. So good, and all the best from me. Thanks.
Thank you, Ruth. Sorry, I have to just interject on one point. Real estate lawyer in me, can't keep it down. Ruth made some really good points, but the way that we have found works quite well with landlords is to split them up between operational pandemic clauses and ones that go to finance. The operational ones are the ones that Ruth covered with performance of obligations, etc., and notices. And then the financial ones, which are the more hard ones. So it's great to see the majority of you have got them in, because they're a pain to negotiate. Landlords don't like them. And we found that the operational ones we can get in relatively easy, as opposed to the financial ones. So it is almost worth splitting them out just for the mindset of the landlords, in that this benefits both of us, saves us both time from management perspective, having to have conversations, etc. So that's my bit. I'll go back into my hosting role now, like a good girl. So introducing the lovely Nick Wint, who I've known for a very long time, since I was a baby lawyer. So Nick's only 18, so that's delightful. He is senior partner and head of the lease advisory department at Johnson Fellows. And Nick's going to talk to you about valuing in a pandemic market. He's going to give you a general market overview. He's going to talk to you about how pandemic wording is going down in the marketplace. And he's got his crystal ball out, ladies and gentlemen. He's going to tell you what the future holds. So, Nick, the chair's all yours.
Right, thank you very much, Beth, and good afternoon to everybody. And thank you very much for the introduction. It's much appreciated. When David Broadbent asked me to do a paper on the current challenges of valuing in the current market and a brief update on the retail property market, I wondered if David had mistaken me for Gypsy Rose Lee. So here we go, fellow psychics. Since the 23rd of March 2020 and Boris Johnson's proclamation that the country is shut down, and the more recent government announcement this weekend that we're all going to do it again for at least a month, has thrown the market into turmoil once more. And just when we all thought it was starting to look a bit better and things were starting to return to some sort of normal. Working in the retail property market is not exactly a great dinner party opener, but the fact is the retail industry employs a huge amount of people and is fundamental to the vibrancy of our towns and cities, as well as the economy as a whole. I hear almost weekly that the retail industry is changing faster than ever before. The fact is the retail industry was never static before the advent of the internet and online shopping. The last time we were faced with such a dramatic change in the market was the collapse of Lehman's in September 2008 and the ensuing financial collapse. The pandemic is likely to make this look like a walk in the park, and the consequences are of such importance that the effects will be felt for generations. So what does this mean for the retail property market? Well, for the next few years, there'll be very few transactions taking place, and the lack of evidence will present huge challenges for valuers across the country. We as valuers generally rely on evidence in order to attribute a value to a similar object. However, the fact that there may be no evidence doesn't, of course, mean that something has no value or price. Valuation, we are told, is an art, not a science, because no two properties are identical. Each property has a unique set of qualities and characteristics that may suit one occupier but not another, and which may change over time. So what external factors have affected the retail industry apart from changing fashion and trends? Internet shopping or e-tailing has shifted the retail market so drastically and so quickly that it simply hasn't been able to respond or adapt quickly enough. The shopper now has the world's market at his or her fingertips and is no longer prepared to accept a much narrower choice of goods previously only available on a shop's shelves. You've gone too fast. This transition is certainly going to continue to affect the retail market, which will shrink further, and as a consequence, there'll be less and less market activity and fewer transactions. So what's going to happen to retail over the next few years and beyond? The flippant answer would be that retailers will simply pull the shutters down, move online, and hand their keys back to the landlord. However, bricks and mortar retailing is still hugely important, and I expect will remain the largest share of the retailing market despite the growth of internet shopping. Internet shopping will find its equilibrium, and I expect those pure internet retailers will also go through their natural business life cycle, with some continuing to dominate and others falling by the wayside. So what can a landlord or a tenant do when there is no transactional evidence? The obvious starting point is the effective valuation date. In rent review cases, the valuation date is, as we all know, generally specified in the lease and requires the parties to fix a value as at that date. The rent review world is, as you know, a hypothetical construct and that seeks to try and create, as closely as possible, the circumstances of an open market letting. The valuation has to be made with the benefit of knowledge of market activity and transactional rental evidence available up to that date, but not beyond that date. In other words, it's looking back and not forward. In the case of lease renewals, the relevant valuation date is not definitive, and indeed there are several scenarios where different dates apply. The valuation date is therefore critical for two principal reasons. 1. Did the valuation date precede a market-changing event? 2. What was the state of the market and the relevant comparable evidence at the valuation date and after the valuation date? So, in the case where the valuation date is 25th of December 2019, i.e. before COVID-19 hit the UK, but was known in the Far East, should the valuation completely disregard the effects of the virus and the pandemic? Should a rental valuation as at the date of the 25th of March 2020, i.e. 2 days after the government's first lockdown, but before any effects are translated into the economy, also be taken into account? So for valuation dates clearly impacted by COVID-19, where there may be no or limited market activity, how do we establish the market rent? Although we've not faced anything comparable to COVID-19, there have been other events that have brought similar issues to bear. As seismic and as tragic as the events of 9/11 and 7/7 had on the world, they somewhat surprisingly only had a limited impact on the property markets and rental valuations in the months following these events. They were not, therefore, market-changing events. The collapse on the 15th of September 2008 of Lehman Brothers, a global financial services firm, and at the time the fourth largest investment bank in the USA, was, however, a market-changing event. Valuation events up to the 14th of September were not impacted. However, all that changed from the September quarter day of 2008, just a few days after the collapse. From the 15th of September 2008 onwards, all valuations reflected the negative impact of Lehman's collapse, which continued on to 2009 and 2010 until the markets and occupiers started to find their way again and regain much of the confidence they had lost. 8 years later on, in June 2016, just 1 day before the June quarter, the UK voted to leave the EU, much to many people's surprise, including our present Prime Minister. Unlike Lehman's, the date of the event was known well in advance. So it wasn't the date that caught everyone out, but perhaps the decision. It too was a market-changing event in many respects, and many commentators made statements that the stock markets and property markets would collapse. and there would be an exodus of workers leaving our shores. But in the significant majority of cases, and perhaps surprisingly, no downward adjustment was made to rental valuations or in arbitration awards or expert determinations for the June quarter day of 2016 or the subsequent dates. COVID-19, though, is quite clearly an event of very different proportions because it's a global pandemic affecting all sectors of the economy, all the working population, consumer expenditure and consumer behaviour. It is without doubt the biggest and the most damaging market-changing event with the full repercussions incalculable at present. So apart from applying common sense to valuations, which us surveyors tend to do, in the knowledge that common sense does tell us all the world is flat and may not therefore be the best solution, what legal guidance is there? Well, if we start with Ponsford versus HMS Aerosols, it was held in relation to a rent review that major events post-dating a valuation date ought to be disregarded. Justice Whitford said, the assessment should be made in the light of the assessor's knowledge as to the state of the market up to the period when the new rent was due to come into force effect, but that there should be omitted from consideration any developments that may have taken place subsequent to that date. So, as at the 25th of December 2019, it's arguable that COVID-19 was an unknown entity, or at least the extent to which it would affect the world. No one could have predicted the events as they have unfolded, or the unprecedented intervention by the government through the furlough scheme, the monetary grants, and all the other financial support measures we've seen. So as at the December 2019, it's arguable that COVID-19 should be disregarded under the principles of Ponsford. And it seems the valuations effective into early 2020 have not taken into account COVID-19. But what about lease renewals and rent reviews that were in play post-March 2020? The effect of COVID was clearly in evidence, so it would be reasonable to expect that those that were either in negotiation or had been agreed but not yet completed should reflect the effects of COVID, and therefore will need to be adjusted to take into account the effect of the virus. The second legal case, which may help, deals with what evidence would be admissible and how relevant it post-dated a valuation date. So in Sagama versus Penny Leroy, the case involved an appeal on an arbitration award where the arbitrator found that post-dated evidence was admissible, stating, I accept that the further away from the review date one progresses, then the rental evidence will become progressively unreliable as evidence of rental values at that date. This is, however, a question of weight and not admissibility, and is a matter for me to consider when reviewing the evidence. So, in such circumstances, it is a question of what weight a valuer would apply to post-dated evidence, as clearly the further away it is, the less relevant it becomes, varying according to the strength or weakness of the market. A judgment has to be made as to what would have been within the reasonable contemplation of the negotiating parties, or was past a discernible trend in rental levels. These two cases deal with post-dated events and post-dated evidence, respectively. But in the case of COVID-19, there is an overlap between the two. So how should you apply this in the case of a rent review or a lease renewal? The overriding principle is that there should be a presumption of reality. In the context of COVID-19, that reality is that the parties, the willing landlord, the willing tenant, had no prior knowledge of or could not foresee the global pandemic, and so that at any date up to the 30th of December 2019 would not account for it in their negotiations. For rent review dates between, say, the 1st of January 2020 and the 23rd of March 2020, knowledge of the global pandemic, the number of infections and deaths country by country became more prevalent, and the stark realisation of its potential impact on the use of retail property in particular was there for all to see. So in rent review cases, it will be vital for the parties and the tenants in particular to be able to provide a COVID-19, or if you like, an event-changing timeline, effectively detailing the series of events which would have been known to the willing landlord and the willing tenant at any given date. In the current market, where there's been a reduction in the number of lettings, which are, by definition, the best evidence, it will be even more important to ensure a party produces a compelling argument, perhaps based on a timeline of events. At lease renewal, the position is slightly more complicated because of the negotiating strengths of the landlord and the tenant, especially where one party is seeking to vary the terms of the lease. Even prior to COVID-19, the principles established by May were becoming less relevant, with tenants seeking in their renewal leases major variations from the terms of the old lease. For example, every lease includes a rent cessation clause, generally covering damage, but it's very unusual to see a clause that would cover a pandemic. Since COVID, some landlords have been quite open to including such a provision, others, somewhat disappointingly, not so. In my view, the key to getting such changes agreed is having a good working relationship with your landlord or tenant. Good relationships in difficult times are the ones that mean the most, and we all now need to work together more than ever. Furthermore, it will become even more important to rely on the skill, expertise and judgment of your agent, expert witness or in-house surveyor to get to the right valuation. So I'd now like to move on to talk about a quick overview of the market. The hospitality sector has been particularly hard hit by the pandemic, and many good businesses sadly will not survive. However, as an industry, it's clearly not finished. But like the retail high street, it will go through a transition over the next few years. People still enjoy going out, and I will, I'm sure, realise how much we've taken it for granted once the pandemic's over. The high street itself was in a state of change for over 10 years prior to COVID. The pandemic and the general convenience afforded to the online shoppers has now just speeded up the process. Town centres need to find their identity again. For too long, commentators have criticised many towns for looking and feeling the same. The visual appeal and the independent character of many town centres has long since gone. Many of the classic 1960s, 1970s, 1980s in-town shopping centres are now simply obsolete and have come to the end of their economic life. Many were built and designed in an age that is no longer fit for the needs of today's shoppers and retailers. They would have been demolished long ago had it not been for the restrictive planning policies, the property laws, and the property-owning companies milking their assets for too long and failing to make the necessary money available for reinvestment. Many retailers simply voted with their feet when newer and better schemes opened in the town centre or a nearby retail park. The examples of this are everywhere across the country and in all of our hometowns. We've seen it. However compelling internet shopping is, I'm sure when the pandemic's over, we will all realise, if we haven't already, how much fun it is actually to go out, buy something, take it home, there and then. Trawling through the internet for an item is fun for a few minutes, but it gets monotonous and frustrating very quickly. As a final point, I'd like to say something about market rents and turnover rents, and I know we've discussed that a little bit earlier with Ruth. Market rents are the accepted norm, and yet for nearly 35 years I've been told that the turnover rent basis is coming in as its replacement. The times I hear this most are, however, in recessionary times, when things are difficult and when the disconnect is at its greatest between the market rent and the rent being paid. There is no doubt that having a rent linked to a business's turnover is an attractive proposition. But not if a retailer is hugely successful and could therefore have been paying significantly less rent had it agreed a market rent at the time. Why would a successful business want to pay more rent than a less successful competitor? Maybe one solution to the problems of the high street would have been the proposal in the late 1990s to abolish upward and downward rent reviews. Sadly, by the time it looked as if it was a realistic prospect, the market had taken off and no one had envisaged that a few years later, the collapse of the financial markets and the advent of the internet would put the market and rental values into reverse. This, in my view, would have probably saved a number of retailers, not left so many landlords with so much empty space, and allowed rents to adjust more quickly without the threat of having to go down the route of administration or a CVA. So, in conclusion, where does this all leave us? Without doubt, there's going to be a significant hiatus in the creation of new rental evidence, and there will be few true arm's-length open market transactions over the next 18 months, if not longer, such that there will be limited evidence available to decide either rent reviews or lease renewals. The skill and judgment of the valuer will be even more important in these times. And I believe that it will be legitimate to consider non-activity, such as the failure of properties to let on the open market, suggesting a market weakness, pointing to a lower rent that had previously been applied when the market was stronger. We will have to use whatever evidence is available, traditional or not. In markets such as this, it's a huge challenge to find the right answer. But I think we may have to accept that in the absence of true market evidence, there may be more than one right answer. Thanks ever so much, and I'll hand it back to Beth. Thanks again.
Thank you, Nick. Right, so last but not least, our Kirsty Black, who I've driven mad over the last 8 months, so thanks for your patience with me. So Kirsty is going to talk to you about landlord's remedies, some tactics, and the great big cost question. So Kirsty, handing over to you. Thank you.
Thanks, Beth. Okay, so it seems like deja vu again as we go into lockdown part 2, but I think the situation is slightly different from then because we've got a lot more clarity on where we are with landlord's remedies. So I've just put a quick reminder on the slide in front of you just to show the main remedies for landlords. So just to run through this very quickly, changing the lock, so forfeiture here in England, and then irritancy, as they call it in Scotland, has been impacted by the government coming in and putting in place legislation. So it's currently prohibited in England and Wales until the 31st of December 2020. We are expecting that to be extended again, but we don't know. But I think with the current lockdown, that's the expectation of most of our retail clients. And then in Scotland, you have to give 14 weeks notice, so you'll get plenty of notice if they're going to irritate north of the border. Same situation with the bailiff action, so people turning up to take your goods. In England and Wales, that's currently prohibited in relation to rent, again, until the end of this year. It is still permitted, actually, in Scotland, and so it is very wise to just be aware that landlords do have more remedies north of the border, and they are using those at the moment. So you might want to treat your property portfolios differently north of the border because of that. Court proceedings I'm going to concentrate on in a minute, but they are currently permitted. That seems to be the loophole that landlords are going through, loophole or not. And then finally, statutory demands winding up. That's the same across the various jurisdictions. They are currently prohibited unless the landlord can show that your business has not been adversely affected by the pandemic. I think that's very unlikely in relation to retail premises unless you're selling maybe the sole supplier of cleaning products and hand gels. So I think unless you're in that situation, that's going to be likely that landlords can't go down that route. And then summary diligence, which is various different mechanisms, again, that the landlords can use in Scotland, is something just to be aware of. And if you need any more information on that, then please do contact us and we can put you in contact with our Scottish colleagues that can go through all of that. So just looking at court proceedings, I know this has been something that's been discussed by the retail community because whilst the government have been very good at putting in place the moratoriums in relation to all of the various remedies by landlords that they can take in relation to rent arrears, there is this gap, and the gap is court proceedings. Initially, before the moratoriums were put into place, we saw a lot of notices under the commercial rent arrears recovery, so we saw a lot of CRA notices. We saw quite a few threats to wind up. Obviously, those have gone away in the majority of circumstances while the moratoriums remain in place, but what we've seen is a real uptake in landlords issuing letter before actions in the last few weeks, particularly once that the moratorium was put in place to extend to December. Lots of landlords, I think, were sitting on their hands waiting for October to come, and have now, you can see, there's no winners or losers here. We've said that throughout at Shoosmiths. You know, from the landlord's perspective, they're not getting their income. Obviously, from the tenant's perspective, in retail, you're not able to trade. So the landlords have got frustrated, and we have seen a huge amount of letters before action and claim forms arriving with our clients in the last few weeks. So just to run through what that looks like, you would expect to get served with a letter before action, giving 7 days notice in which to pay the rent arrears. If a deal isn't done with the landlord in that time, or obviously if the retailer doesn't concede the claim, you will then get a claim form. Normally short and sweet, it's a debt action at the end of the day. The acknowledgement's due within 14 days of that claim form, otherwise there is a risk of default judgment, so get that in. And then the defence is due 14 days after the acknowledgement, so that's 28 days. We've seen a lot of landlords go for summary judgment in the last couple of weeks. Summary judgment is where the landlord is saying that the tenant has no case to answer and no reasonable prospects of defending. A landlord is able to apply for summary judgment as soon as that acknowledgement of service has gone in, so after the 14-day period. In relation to summary judgment, it's just important to highlight to you all that the government hasn't taken any action in relation to court proceedings or in relation to the fact that the rent is due under the terms of the lease. Rightly or wrongly, the rent is due. I'll come on to some defences that we have, but there is a real risk of summary judgment, and there's a couple of High Court cases due to go to court at the end of November, which I'm sure if the landlord is successful, we're going to hear about, and it will be widely publicised. So I do expect more summary judgment applications to be made. If the landlord doesn't go down the route of summary judgment, you'll have all the usual directions through the trial, so disclosure, witness statements, you shouldn't need expert evidence, and then you'll have the final trial. Either after a successful summary judgment application or your final trial, you will end up with a CCJ, a county court judgment. So what are the options for the landlord once they get this county court judgment? Well, first of all, there is the option for the bailiff. So the county court, the bailiff in respect of commercial rent recovery is affected by the moratorium, but the bailiff in respect of a county court judgment isn't. So the landlord will be able to ask the bailiff to attend stores and actually other premises, you know, to get assets that you own. The winding up petition isn't an option that they can go for whilst the moratorium remains in place. That's across the board, so it's in relation to any debt, any county court option, so they won't be able to go for winding up until the moratorium's lifted. What might be a concern, though, is a charging order. So particularly if you've got freehold assets as a company or any other assets that, you know, are of monetary value, the landlord would then be able to go to court to ask for them to put a charging order on that asset, and then the next stage is an order for sale. So effectively making you sell that asset so that they can then get their debt back. They are all obviously longer term options. The biggest effect of the CCJ that we've seen on our clients that have had judgments issued against them is actually the effect on everyday supply agreements. So even as simple as booking a hotel for their employees, the suppliers have links into these county court judgments. It immediately puts a red flag, and in some cases it just puts a complete blanket no on getting any credit. So it's that practical aspect that you don't want to be in a position where you have a county court judgment issued against you, because it is impacting massively on things, like I say, as simple as booking a hotel and getting that credit. So turning next to the strategy that we're adopting, I want to make it very clear right from the outset that we're calling these ambitious arguments. You can take from that what you will, but we are using ambitious arguments to try and delay. And the whole strategy is about coming to an agreement with the landlord. Everything that I'm going to talk about in the next couple of minutes is about trying to bring the landlord to the table, and in the background, with the code of practice, you know, using all of the content of that to say, let's come to a deal and let's try and look at whether or not we can, you know, get some kind of rent-free deferment, all the things that we were talking about earlier in terms of moving forwards and putting the landlord and tenant relationship back on track. So the first thing we'll do when we get to letter before action is write back with our ambitious legal arguments. The first one is supervening illegality. That really only applies to businesses that have been not able to open throughout the whole period. So an obvious one is nightclubs, where it's unlawful for them to open. They can say it would be unlawful for us to comply with the terms of this lease and open, and therefore we shouldn't be paying rent. The second two, implied term and frustration, have no current basis, shall we say, in English law. We could well change that with the cases that are going to court, but effectively it's saying that had the parties stepped back at the beginning of this lease and said, you're not going to be able to open during this period, your trade's going to be massively affected, we've got all this social distancing in place, would they have said, but we still expect you to pay the rent throughout this whole period? And the answer that we're saying is no, they wouldn't, so the court needs to imply a term into the lease to say that. Like I say, ambitious argument, but it's one that we're running. The third one is the rent cessor under the insurance provisions. We have had a number of insurance policies sent through to us by landlords when we've been requesting them as part of this argument that do cover pandemic. Now, it's the hurdle to get over the fact that there is insurance in theory in place, but has it caused damage? Because your standard provision in your lease is that it's got to cause damage or destruction to the property, and that's the challenge and the innovative legal argument that we're running. To say, actually, if you drag that wording into the rent cessor clause, then it's what damage can be caused by a pandemic. The only damage that can be caused is that it's going to damage our trading, and therefore it is covered by the insurance. So we are pushing back strongly on landlords, and we have had a QC say it's 50-50 if you do have pandemic insurance policy in place. So, you know, that's kind of, it's still, for me, optimistic with 50-50, but it's a good thing if we do have that in place. So then looking at how we try and resolve this with the landlord when we're bringing them to the table, and a lot of questions are being asked about service charge. You know, should it be paid, particularly when landlords have shown that they've tried to make the savings? In all honesty, you know, take it out of the equation. If you've got service charge and there isn't a dispute, it's a olive branch to the landlord to say, yes, I am prepared to pay that because I can see that you've made cost savings and we're prepared to take that out of the equation. The other thing that we've done strategically for a number of our clients is look at paying down the rent arrears to reduce costs. The standard for the big landlords seems to be that they're giving 6 weeks rent-free. So pay it down to 6 weeks, and then rather than paying 5% of your £100,000 rental arrears, you're only going to be paying 5% of the 6 weeks. So pay it down to the 6 weeks or a month, reduce your court fee, you know, which can be a significant amount. It's 5% up to a maximum of £10,000. But also, is the landlord then going to go for the proceedings if you've paid that amount? Is it going to bring them to the table? And then the final thing that seems to be actually when we get into this level of summary judgment is costs. You know, I've had a very well-known landlord issue me with a cost claim across 2 properties for nearly £40,000 worth of costs, £26,000 worth of solicitors' costs, 2 court claims with 10 grand on for each of the court fees, and then £7,000 of a QC's costs to draft a very, very simple debt set of proceedings, which is just outrageous. Costs are going to become an issue, so check the lease, check whether it's reasonably and properly incurred, but there's often an exception apart from in the case of tenant breach. It's not going to be the cost provisions necessarily under CPR, so, you know, proportionality. I've got one where the costs are something like 12,000 and we're only arguing about £10,000 worth of rent. We'd normally argue proportionality, but it's very difficult when they're claiming costs under the terms of the lease. And then finally, just something, again, to bring to your attention as part of the 36 offer, we've had a spate of these coming through recently as well, and the impact of these, when a landlord is successful, and, you know, it's more likely, I've put in pink, that's the more likely scenario, is that if a landlord's claiming £120,000 worth, for example, of arrears, they offer to settle for 110. If you accept, they get their costs on a standard basis up to the date of acceptance. You know, they're probably entitled to those costs under the terms of the lease anyway, so you're not in a worse position. If a tenant doesn't accept, there's now more sanctions on a Part 36. The court's put these in place effectively to try and encourage parties to settle. So if the landlord then beats its offer, which is more than likely to, because the court's more than likely to give them the £120,000 worth of arrears, then they get interest up to 10%. They get indemnity costs, so that means full costs, so up to 90% rather than your standard discount of 20 or 30% from the end of the relevant period. That's normally 21 days. They also get interest on those costs up to 10%, and then the court does have a discretion to give this additional amount of 10% of the amount awarded by the court. So here, you know, if we're going to get the amount awarded at £120,000 plus the interest plus the indemnity costs, you're looking at probably £12,000 to £15,000 as just a penalty for your failure to accept that offer, which then just gets added onto your bill. So we just need to be mindful of those, and on everything to do with these rent arrears. And I suppose this is how I'll kind of sum up and finalise. We're trying to get the landlord to the table to do a deal. Some landlords just simply won't. And in those circumstances, we've got to look at the cost versus the benefit of the delay. So from a cash flow perspective, you might very much be, you know, adopting a strategy of trying to delay for as much as possible. But once we get to this position where we've got proceedings, we've got, you know, summary judgment application, or even the landlord's about to issue proceedings, we're going to incur that court fee. Just thinking about how you can protect your position in that regard, make holder bank offers yourself, come to the table, say that you'll accept a month rather than 6 weeks, just to get that across the line before we end up going to court. And unfortunately, it's more likely than not that the landlord's going to win that court battle.
Right. Thank you, Kirsty. Right, you'll be pleased to hear we've got 4 minutes left, so they've got 1 minute each for a question, and then we'll just do the thank yous and round up. So, Kirsty, what if a letter for action is served on the premises only during the second lockdown and no staff are in store to check it?
We've had this happen a few times. There's no specific requirement for landlords to serve letters before actions at a registered office address, but I would expect it to be sent to the estate surveyor and not to the premises, to be honest. But it happened the first time when offices were closed, and we ended up with default judgments as a result. I would argue against costs. I'd say you know who the estate surveyor is, you know who your contact is, you know who's dealing with this, you should be sending it to them. So we might be able to argue against costs, but that is a very tricky scenario.
We are in our COVID operational clauses as well, putting an ability to serve by email during lockdown. So I would recommend that one as well if you're in the middle of negotiations.
Absolutely.
Right, Kirsty, thank you. Nick, one for you. Do you think that the retail and leisure market need to work together more to ensure there's experiences to draw in people to come and shop and do other things? One example being the Bull Ring, where they're introducing this huge climbing wall where Forever 21 were once situated.
Yeah, very much so. I think it goes without, said really. It needs to be an experience. People are just not prepared anymore to simply go out and shop. It has to be a day's event. So yes, very much so. And you see more of that. As you say, you see it in the Bull Ring. You see it in town centres when they're trying to create vibrancy. The old way would have been to introduce farmers markets or general markets where that would bring people in. Now, obviously, people are more sophisticated and they're looking for more leisure pursuits to be brought in, to make it more interesting. But yes, very much so.
Okay, and Ruth, one for you. Do you think we'll see service charges being included in turnover rent more than we have done traditionally?
Definitely, yes. I'm seeing it more and more. So the idea that you are not only doing a turnover rent, but a TOC lease, so a total occupancy cost. So it certainly more, and that's what I'm saying. It used to be just the rent, and now it's quite different. I'm seeing very, very different structures. Sometimes service charge, sometimes insurance rent, even sometimes business rates. But these TOC leases certainly.
Lovely, thank you. Thank you all. David, is there anything else you want to say, having all of the panel discuss their various elements?
I think the only thing I would add from a pure valuation point of view is actually you as the retailers are creating the new evidence in the market, irrespective of what the landlord's view of the world may be. We as a business have either said hostile breaks where we've got them in our leases, or actually discontinued lease renewal proceedings where actually they were clearly barking up the wrong tree over values. We issued the discontinuance notice and then basically offered them a new lease based on a 5-year term break at year 3, and a level of rent we were prepared to pay. What I would caveat is that the offers of the level of rents we were prepared to offer were not, shall we say, they were fair and reasonable offers to cover the landlord's income. Not landlord's income, the wrong word, but they weren't complete Mickey take offers in the current market. But what could we afford to pay versus our current trading and forecast projections? Could we make money from that store, taking into account business rates, etc.? And to be honest, I've only lost one store so far this year where the landlord hasn't done the deal and they've now got it back. All the others we've achieved 40, 50, 60% rent reductions by creating new evidence ourselves. So those in-house retail teams, be bold, serve your break, serve your 27 notices, but obviously make sure your boards know, because it's a one-way bet if it goes wrong.
Yeah, I mean, we've never served as many breaks and Section 27s and notice discontinuances ever in my career. So yeah, lots.
I think until it actually lands, the landlords don't believe you. The landlords don't believe you. But actually, when that notice lands, you've got 3 months, guys, to do a deal with us. Otherwise, we're off. Less than that, because you've got to close your stores down, inform your store teams. You've got about 6 to 8 weeks to get it over the line and done. And certainly in places where you think you would lose the store, where there was a high risk of the landlord calling your bluff, it's interesting times. There's nobody to backfill that space currently. And if you're a solvent retailer with a good covenant, landlords will do deals with you.
And the business rates makes a huge difference, David, of course, because you're then effectively going, here you go, you can pay the business rates. We don't have to pay it, but you do.
I have 2 stores in central London which are on no rent because of the business rates.
Yeah.
And those are fairly prime central London sites where the landlord don't want them back. There's an ongoing conversation what the hell that means for us from 1st of April and whether or not they're going to get them back, because we've got flexibility on those stores as well.
Mm-hmm.
Great. Thank you, David. Well, it's handy you've got questions up on the screen. So Shoosmiths, as part of their Shared and Half campaign, are holding a question and answer session on Friday at 11:30. Details will be circulated. So if any of you would like to attend and or have questions that we can or cannot answer on the WebEx itself, and if not, we'll come back with answers hopefully at a later point, then we'll circulate details on that as well. But in the meantime, thank you all so much. Thank you to the lovely, gorgeous panel for your input. And thank you all for watching, and we look forward to seeing you again very soon. Take care of yourselves and stay safe.
Thank you.
Thank you.